Attention all pensioners, retirees and families across the United Kingdom. If you are age 66 or over, or if you have relatives receiving the state pension, you need to pay very close attention to what I'm about to share with you right now. Urgent official updates regarding the winter fuel payment for 2026 have just been confirmed by the Department for Work and Pensions and HM Revenue and Customs. What is happening this year is going to send shockwaves through millions of households, from Cornwall to the Scottish Highlands, from Wales to Northern Ireland. For the past few years, we have seen complete chaos surrounding winter support. First, it was a universal benefit given to every single person over state pension age. Then came the sudden decision to strip it away from over 8 million pensioners, restricting it purely to those receiving pension credit. But now, in 2026, the government has officially rolled out a brand new system that changes the game entirely once again. Millions of pensioners who were previously cut off will get their payment back this winter. But there is a massive hidden sting in the tail that could leave thousands of retirees facing unexpected tax demands or adjusted tax codes. If you think you can just sit back and assume everything is taken care of, think again. The rules surrounding individual taxable income, the official qualifying week in September, and the new automatic clawback mechanism mean that understanding your exact financial position right now is more critical than ever. In this broadcast, I'm going to break down every single rule, every threshold, every exact payment amount, and reveal how you can protect yourself from getting caught out by HM Revenue and Customs. Before we begin, I would like to remind you that many pensioners could be eligible for a new extra support payment of £200. If you have not heard about this yet, I have left detailed information from an official source in the comments below the video. Make sure to check it out. And now, let us move on to the topic of today's video. What exactly are the new rules for the winter fuel payment in 2026, and why is everyone talking about them? To fully grasp why this update is so significant, we have to look at what happened over the last 2 years. When the government restricted the payment strictly to recipients of means-tested benefits like pension credit, it sparked widespread fury. Millions of hard-working retirees who were living just a few pounds above the pension credit threshold found themselves completely frozen out, struggling to heat their homes during the coldest months of the year. Recognizing the immense public pressure, the government announced a major policy overhaul. For winter 2026, eligibility for the winter fuel payment has officially been restored to everyone over state pension age across England, Wales, Scotland and Northern Ireland. That means roughly 12 million pensioners across the country are once again eligible to receive payments automatically in November and December. However, here is the crucial catch that you must understand. The government has introduced a new mechanism called the Winter Fuel Payments Charge. Under this new rule, if your total individual taxable income for the relevant tax year exceeds £35,000, HM Revenue and Customs will automatically recover the full amount of your winter fuel payment through the tax system. Think about what this means. Over 3/4 of all pensioners in the United Kingdom, around 9 million people, will receive and keep their tax-free payment because their taxable income is £35,000 or less. But for the roughly 2.2 million pensioners whose income tops £35,000, the government will give the money with one hand and snatch it right back with the other. This creates a massive debate. The government argues that £35,000 is well above the income level of pensioners living in poverty, ensuring that support is targeted towards lower and middle-income retirees. But critics are already pointing out major flaws in this system, particularly regarding household fairness. Now, let us examine how HM Revenue and Customs decides whether your income is above or below £35,000. The £35,000 limit applies strictly to your individual taxable income, not your total household income. This distinction is absolutely vital. What counts as taxable income? First, your state pension counts as taxable income. Second, any private or workplace pensions count as taxable income. Third, any earnings from employment or self-employment count as taxable income. Fourth, any taxable rental income or taxable interest earned on savings counts towards your £35,000 total. What does not count as taxable income? Pension credit does not count as taxable income. Attendance allowance, personal independence payment, and disability living allowance do not count as taxable income. Housing benefit and council tax support do not count as taxable income. And crucially, any savings held inside an individual savings account, commonly known as an ISA, are completely tax-free and do not count towards your £35,000 threshold. Let us look at a provocative real-world example to show just how unfair this rule can be. Imagine couple A. Husband John receives a private pension plus his state pension, bringing his individual taxable income to £36,000. His wife Mary receives only the full basic state pension of around £8,000. Because John's individual income is over £35,000, HM Revenue and Customs will claw back his share of the winter fuel payment. However, Mary keeps her share because her individual income is below the threshold. Now consider couple B. Husband Mark earns £34,000 in taxable income. Wife Sarah also earns £34,000 in taxable income. Together, their combined household income is a massive £68,000 per year. Yet, because neither individual crosses the £35,000 threshold, both Mark and Sarah get to keep their winter fuel payment in full. That is £300 kept by a household earning £68,000, while a couple living on £44,000 loses part of theirs. This glaring disparity has caused intense debates, but as the rules stand for 2026, it is your individual taxable income alone that dictates whether HM Revenue and Customs will take your money back. So, how much money are you actually entitled to receive this winter? The amount depends on two main factors: your age during the official qualifying week and who lives in your household. In law, the qualifying week for 2026 runs strictly from Monday the 21st of September through to Sunday the 27th of September 2026. To be eligible, you must have reached state pension age 66 years old on or before the 27th of September 2026. Here are the exact individual payment amounts based on your age and circumstances. If you live alone and were born between the 23rd of September 1944 and the 22nd of September 1960, aged 66 to 79 during the qualifying week, you will receive £200. If you live alone and were born on or before the 22nd of September 1944, aged 80 or over during the qualifying week, you will receive £300. If both you and your partner are aged 66 to 79, the £200 household payment is split equally between you, giving you each £100. If both you and your partner are aged 80 or over, the £300 payment is split equally, giving you each £150. If one partner is aged 80 or over and the other is between 66 and 79, the older partner receives £200, while the younger partner receives £100. If you live with a partner who is under state pension age, you will receive the full payment for your age bracket as an individual, either £200 or £300, provided your individual taxable income remains at or below £35,000. In Scotland, under Social Security Scotland, the pension age winter heating payment mirrors these exact eligibility criteria, with slightly uprated rates of approximately £203.40 for under 80s and £305.10 for those 80 and over. Now, let us get to how HM Revenue and Customs will claw this money back from higher earners. If you earn over £35,000 in individual taxable income, the Department for Work and Pensions will still send the £200 or £300 directly into your bank account as usual during November or December. Then comes the clawback via one of two methods. Method number 1. For pensioners whose tax is collected through pay-as-you-earn, known as PAYE, HM Revenue and Customs will alter your tax code for the following tax year to deduct the money gradually over 12 months. Method number 2. For pensioners who complete an annual self-assessment tax return, HM Revenue and Customs will add the winter fuel payments charge directly to your tax calculation at the end of the year. Because this automatic clawback system can create confusion, the government has launched an official online opt-out portal on the official government website. If you know for a fact that your individual taxable income will exceed £35,000, you can log on to the official government portal and choose to opt out of receiving the payment altogether. This prevents the hassle of receiving cash in November, only to have it recovered through tax adjustments later. Once you opt out, you remain opted out for future years unless you manually change your preference. However, a serious word of caution if your income fluctuates close to £35,000. If your income fluctuates due to occasional work or savings interest, be extremely careful before opting out, as you could miss out on money you were entitled to keep if your final income falls below the limit. It is also vital to remember that the winter fuel payment is just one part of the wider safety net available to UK retirees. If you are struggling financially, check if you are eligible for pension credit immediately. Over 800,000 eligible pensioner households across England, Wales, Scotland and Northern Ireland are still missing out on pension credit, leaving billions of pounds unclaimed every year. If you receive pension credit, your income is guaranteed to be well below £35,000, meaning your winter fuel payment is completely safe from clawback. Furthermore, pension credit unlocks council tax exemptions, a free television licence if you are age 75 or over, free NHS dental care, the warm home discount worth £150, and cold weather payments worth £25 for every 7-day period of freezing weather. Claiming pension credit could be worth over £3,900 a year to a single pensioner, or over £5,900 to a couple. If your weekly income is below £218.15 for a single person, or below £332.95 for a couple, check your eligibility online at the official government portal, or call the Department for Work and Pensions claim line on 0873 10 160. As we prepare for winter 2026, remember these key takeaways. First, check your expected individual taxable income. If it is £35,000 or less, you will keep your full winter fuel payment. Second, if your income exceeds £35,000, decide whether to let HM Revenue and Customs recover it or use the official online portal to opt out cleanly. Third, look out for your official notification letter from the Department for Work and Pensions throughout October and November. Most payments will arrive in November and December 2026. Fourth, share this video with friends and family so every retiree understands these new rules. What do you think about these new rules for 2026? Is the £35,000 individual threshold fair? Leave a comment below and let us know. Please like this video, subscribe to the channel, and turn on all notification bells so you never miss another urgent breaking update on UK pensions. Thank you for watching, stay warm, and I will see you in the next update.